Don't forget to put your city and state in the chat so we can recognize you. Put your city and state in the chat so we can recognize you today. And we hope that you all are doing well. Raymond, can you hear me?
Yes, I can. Can you hear me?
Okay, say that again.
Can you hear me now?
Yeah, I can hear you. It was on my my end. So, how are you today?
I'm doing great. Yeah, I'm just glad to get a day off of work and plan to go to the movies later. So it's a great day.
Very cool. You going to see the new James Bond? What are we seeing tonight?
Absolutely. James Bond. Yes.
Cool. All righty then. I guess I'll watch it at some point eventually. So, um, hello, everybody. We have in the house Chicago. We got Winston-Salem, North Carolina. We got Westchester, New York. We got San Leandro, California. We got Frisco, Texas. Another Winston-Salem. Mark from Tacoma. Juanita from PA. We've got Denver in the house. Everybody give us your city and state in the chat. Let us know where you are coming from. Today's session is going to be fun because Raymond has invested in over 150 private equity crowdfunding deals. So he is here tonight to talk about his experience with that. We actually have a jam-packed show because I'm going to just do a little bit of education about what equity crowdfunding is. Then I'm going to interview Raymond. And then as a cherry on top, what we're going to do is review a little bit of this book here. There we go. It's called Super Founders. And it is a guy that took over 30,000 data points about billion-dollar companies that were started. And what he wanted to find out was like information about what the companies were like when they first got started with regards to the age of the founders, the sectors that they were in, had the founders ever worked before, what types of jobs they had, things like that. So it's really cool information that I thought that Raymond and I would tag team on and talk about together. So welcome everybody to the 10K Project. We are the largest community of investors who actively fund Black-owned businesses. And the concept is simple. If 10,000 of us came together and, for example, each of us put in just $100 into a business, that's $1 million. We are able to fund our own businesses. We can profit from our own innovation. We can create jobs in the community, and we can work together to build Black wealth. So Tawana is on a much needed vacay this week. And I will be here obviously today with Raymond, and then tomorrow at the Bet on Black pitch, which is tomorrow at 8 p.m. Eastern time. So Juanita is asking about the book again. Let's see if I can hold it up here. It's called Super Founders. Ali Tomaseb is the guy's name. Super Founders is the book name here. So, and we're gonna go through some of the data points. I've been reading it. I'm about halfway through it. And what he does in the book is not only tell you the data points, but he also interviews these founders of these multi-billion-dollar companies to talk about what it was like back in the day when they first got started. So if you're either a geek like me and you like this kind of stuff, or you want to become a better investor, then you can definitely get that book. I tried to get the author on. I'm still going to try because I think it would be interesting to have him come on and talk about what he discovered from his own point of view. So with that, what I want to do, Raymond, is just tell everybody really quickly a little bit about yourself, what you do, and how you got into investing.
Yeah, thank you for the introduction. I appreciate that. So Just a little about myself. It's a really not a straight and direct forward way into investing in private equity, but undergrad, Bowie State, grad school, Georgetown, a few more classes left for technology management. Working as a military officer in Signal Corps, and currently work part-time for Global Millennial Capital, which is a Saudi Arabia based venture capital firm, primarily focused on US economy. So it originally started, I was trying to figure out what was the most lucrative asset class. And there were two. It was cryptocurrency and it was private equity. And until I realized about the Jobs Act of 2016 during the Obama administration, I noticed that there was a way for individuals who didn't have a net worth of over $1 million or have liquid assets to invest in startups. And then the platforms that kind of came to mind was like Republic.co, WeFunder, Start Engine, and even Seed Invest. And those platforms allow non-accredited investors who are individuals who make less than $200,000 a year and have less than $1 million in liquid assets to invest in this new asset class for retail investors, which would be startups. And then from there, kind of scouring the different crowdfunding platforms and reading a bunch of books like 0 to 1 by Peter Thiel, Angel by Jason Calacanis, and Why Startups Fail. There's just a bunch of different material out there, just so open to give everyone an opportunity to understand what are the things they should look for when wanting to invest in startups.
Very cool. So we're super excited to have you here today to talk a lot more about the investing that you do and things like that. And you're going to be my co-host as well today. So welcome. I know we just thrown you right on in, but it'll be good. You'll definitely be able to be a part of what we're doing here. So the first thing I wanted to do was go over a little bit about crowdfunding, what crowdfunding is. I have a couple of announcements for everybody as you all come in. And then I'm going to do a much more in-depth interview of Raymond, and we're going to go over those super founder data points as well, which I think should be pretty interesting. So the first thing is, what is crowdfunding? And Raymond kind of alluded to it. Crowdfunding is when a group of people get together in order to help put money towards something. Could be anything. The most common example we have currently is GoFundMe. However, in the Black community, crowdfunding was rent parties back in the 1930s. Some of our parents had rent parties in the 1970s. It was how Dr. King was funded during the Civil Rights Movement. We see all sorts of examples and have seen all sorts of examples of crowdfunding within the Black community. However, what we do is something called equity crowdfunding here, which means that we finally get to potentially profit from the money that we are putting into companies, especially into Black-owned companies. So I do want to start off by saying that I am not a financial advisor or a lawyer or anything like that. Always check with your own financial advisor, your tax advisors, your attorneys, et cetera, with regards to the investments that you are doing. But this came across in my social media feed, and I thought it was very interesting. When we started looking at how the rich invest, this was something that came out with regard to the asset allocation of something called family offices. And family offices usually start at families that have $5 million or more in assets to invest. So how do they invest? Of course, a lot of us know what real estate is. Some of us may have real estate. They also have 25% of their money in public equities. That is us buying stock like Nike, Home Depot, Ulta for the ladies, et cetera, things that are already on stock exchanges. However, 22% of their assets typically go into private equity. And there was a time when private equity was only for rich families. However, equity crowdfunding and the Jobs Act of 2012, which we're going to talk about in a couple of minutes, has brought that down and allowed the rest of us to actually invest in those types of companies. So let me give you an example of, yeah, it's a celebrity, but it's just like one of the better examples for me to give, and that is Nas and Snoop Dogg. Put a one in the chat if you have heard of Robinhood. Put a one in the chat if you have heard of Robinhood. I'm going to see the chat here. Good. So I'm starting to see the ones in here. Great. So a couple of people are saying, no, you have not, which is fine as well. Robinhood is a financial app that has become pretty popular over the past few years. If you remember the GameStop issues that came out several months ago where, trading was stopped for that specific stock. Robinhood was one of the companies and financial apps that was in the middle of all of it. But back in 2014, they had approached Nas and Snoop and some other people in order to raise money for their financial app. And long story short, Snoop invested. So Snoop and Nas invested. And they got in Series A when the shares were 19.54 cents. And several years later, 2021, they did an IPO. IPO stands for Initial Public Offering. At the end of that day, the shares are worth $34.82 a piece. So Snoop got in at 19 cents. And at the end of the IPO day, he was at $34.82 per share. Now, we don't know how many shares Snoop bought. That is not in the SEC documentation. However, if he purchased $19,540 worth of those shares back in 2014, at the end of the IPO day, they were worth $3.4 million. That is private equity. That is how the rich are investing and the rich are getting richer. So what if we, the people, could do the same thing? What if we, the people, could earn these types of returns, invest in Black businesses, which are the least likely to get invested in, share in those profits, and do good within the community? That's where the 10K project comes in. The Jobs Act of 2012 enabled people to, just regular people like you and I, they call it unaccredited investors, basically people who aren't rich, to do this type of investing. They call it crowdfunding, and we're the crowd, okay? So the concept of the 10K project is, again, 10,000 people come together. They put in small dollars into a business. We could raise $1 million or more to fund a company, profit from our own innovation, create jobs in the community, and build Black wealth. So the way that equity crowdfunding works at the 10K project is an entrepreneur must go to an SEC-approved equity crowdfunding portal and get on that portal in order to raise money. Again, equity crowdfunding is governed by the Securities and Exchange Commission and FINRA, which stands for the Financial Industry Regulatory Authority, or agency, sorry. Then at the 10K project, what we do is each week we invite a Black-owned business to come and to present their investment opportunity to us. We call that a Bet on Black pitch. Then you, as the member, as the investor, as the person who's watching the pitch, you get to ask that entrepreneur questions, you get to research the company, you get to then decide individually if you like that company and if you want to invest in that company in exchange for equity or partial ownership of that business. If the company makes it big, then the crowd or the investors share in the profits. And if not, then investors only lose what you put into the company. So that is overall how the 10K project works and how we work with equity crowdfunding. So we bring three groups of people together. We bring entrepreneurs who are raising money. We bring together investors who want to hear about these entrepreneurs, these Black entrepreneurs that are raising money and want to invest as little as $100 into their campaigns. And then the third group of people we bring together are experts, because let's say this entrepreneur raises $1 million. Most likely they're going to be hiring people, whether full-time, part-time, or for contract or project work. So do they need an attorney? Do they need a graphic designer? Do they need a full-time employee? We have had these entrepreneurs come and say, I'm actively hiring. And then those entrepreneurs are able to raise money through the investor network, and hopefully they are able to hire from within the community as well. This is Powernomics 2.0, where we can hopefully increase the circulation of the Black dollar from 6 hours to, much, much more than that. So if you want to become a member, we have two options for you right now. The first is gold membership, which you can attend the Bet on Black pitches, be a part of our expert directory. And we also have a whole bunch of wealth building webinar replays in our knowledge center. That is a one-time payment of $100. You never charge for membership again. And then if you want custom financial planning through Freeman Capital, we really do care about your financial health. So that is a one-time payment of $347. You get everything in the gold membership, plus you get a custom financial plan. So that's at the10kproject.com, the10kproject.com. So Raymond, I'm going to open up the chat here for a second. What do you think with regards to, investing and coming together in a format like this in order to invest?
Yeah, so I'm really big on community, right? I know that, more minds, the more great minds come together and more people will believe in the same vision, a lot of amazing things can happen. So I think when there is a platform, I guess, like this, that allows individuals that have a similar focus wanting to invest in minority African-American made businesses, it gives those minorities a better chance of getting the funding they need to kind of propel their business to the next level.
Yeah, so when we started writing the business plan and putting together the information with regard to the 10K project, we looked at a Morgan Stanley report that said that when our businesses are properly funded, we make just as much money as any other ethnically founded group out there. Yet, the big sources of capital, things are getting a little bit better due to George Floyd and everything that happened last year, but the gap is so wide. And one of the things I've been expressing to people is, let's take advantage of that. That's actually not a bad thing. If we decide, hey, you know what, we want to invest and we want to prove that we are able to create just as many successful businesses as others out there, then, that could help the community like infinitely.
Yeah, definitely. I mean, and I think the first step is making sure that our community is aware of these opportunities, and that's why, I kind of started my own podcast, the Money Clip podcast, to let people that are in my community or my age group understand the opportunities that are available. I think a lot of times people just automatically assume that these things aren't eligible or allowed for them, so they don't really exercise their opportunity. But if we are able to create communities like this and bring more people together and allow them to get an understanding as to what is available for them, I think there's an opportunity to help improve, the wealth gap.
Yeah, I couldn't agree more. So I do see Chris Myers in here. Oh, I'm sorry. I usually don't say last names. I'm so sorry. The 10K project needs to replace the lottery in the Black community. I love that. I don't personally play the lottery, but I have to laugh. My great grandmother used to play the numbers. Just as I thought about that, I'm just sorry. That was a good memory though, because we used to go. Yeah. She used to play the numbers. So, but that was back in the day. Angela's saying happy Monday from Tallahassee. Hello, Angela. We also have in Facebook here, Charles is saying what you are doing I love what you're doing. Keep up the excellent work. Well, thank you, Charles. Really appreciate you as well. And of course, everybody in YouTube, I see you here. Y'all need to talk to me in YouTube. And also don't forget to hit the like button for me. So I wanted to just make a couple of announcements because I was supposed to do this before I gotten started with the presentation. But tomorrow, if anybody's an entrepreneur, wants to learn how to raise money and do a Bet on Black pitch, then tomorrow at 6 p.m., that's Tuesday, October 12th, 6 p.m., we are having the How to Raise $10,000 to $5 million for your business session. So you are able to come no matter what stage you are. Go to the10kproject.com, click on the event calendar, and you can register there. Tomorrow night is the Bet on Black pitch. Next Monday, we have 2 members coming. One of them opened up a learning institute in a high crime area, which I think is interesting. And the other one shares encouraging stories. So, both of those people will be here. And then following Monday, October 25th, if you are interested in trade with Africa, we have a woman coming from the Africa Wealth Conference. And the session we're going to have here, October 25th at 6 p.m. is how African Americans can trade with Africa. So we have 2 guests coming to talk about that. One is on the Africa side and the other is stateside. So that's October 25th. Just wanted to let everyone know that. Raymond, you got a question here from Juanita. Could you mention the books you read again? You said it a little fast. And what is the name of your podcast?
Yeah, sure. I get so excited when I talk about these things. So yeah, the first book is it's called Angel by Jason Calacanis. Mm-hmm. Jason Calacanis is one of the few investors early in Uber, Robinhood, Calm, and a few others. So he's it's a really good book. It's easy read. It's not very technical at all, but it gives you understanding as to like what are some of the things you should look for and kind of how you got started in this process from angel investing. So you can kind of use those ideas and theories to kind of formulate your plan when it comes to angel investing. And the second book.
I'm sorry, the Jason Calacanis thing, if anybody remembers, we looked at the video for the GOAT of angel investing. That's the same guy. So Juanita, I know you've been here a while, so you may remember the GOAT of angel investing. That's him. So go ahead, Raymond.
Yeah, sure. And the next book is going to be 0 to 1. That's the book is by Peter Thiel. So the reason why I kind of like that book is because his main theory is to invest in companies that aren't necessarily doing the same thing, right? Like, for example, let's say that there's 2 openings. If everyone's running through the same exact hole, it leaves the other area wide open for exploitation, right? Or for a different avenue of approach, right? So if everyone's doing the same thing, there's going to be a lot of competition. And sometimes competition is not, too much competition isn't good for business, right? So you want to be able to kind of own the own market and create a market in itself. So 0 to 1 is a great book and kind of give you an understanding of a different investment thesis. And the other book is going to be Why Startups Fail. I can't remember the actual author, but Why Startups Fail, I think it's maybe like $38 on Amazon. And it's in real black bold print on the front of the cover. It says Why Startups Fail. Those are 3 good books you can check out.
Perfect. So Chris is asking a great question in here. How long did it take for you to invest in over 150 startups? So why don't you give us like the 5-minute version, 3 to 5 minute version of like, from how you got interested in it to like where you are today?
Yeah. Also one other thing I forgot to answer. Mm-hmm. So my podcast is called Money Clip Podcast. It's a yellow backdrop with black print, and it says by Raymond Brown. It's available on Spotify and Apple Podcasts. And you can also Google it. It comes up as well. Yes. So the investment journey, right? So during undergrad, halfway through undergrad, I was a business major, and I was in a business law class, and I was reading like a really interesting case. And from then on there, I really wanted to understand how to get involved in stocks, right? But every time I saw an opportunity to invest in a stock, it was either too expensive or I thought it was too expensive before they added micro investing. Money Clip podcast. Yeah, Money Clip podcast is the podcast.
Yeah, I found it, everybody. So I'm going to put it in the chat for everyone.
Yeah, so what I found out was that by time stocks hit the public market, a lot of the early investors have pretty much sucked a lot of the value out of the company, unless you're waiting, you want to wait additional, 10 to 15 to 20 years. And I kind of ran the numbers, right? Like if you pay attention to maybe some of the top 5 performing companies, most of those percentage growths might range between maybe a little under 100,000% up to 3 million%. The closest one that has the highest performance that I've seen so far is as far as one of the well-known companies like Microsoft is over 3 million%, right? And what you really want when you want to do is you want to see like, how can I take my dollar the furthest? And what I found out is if you're able to invest in a company when they're just starting out, there's a potential for you to have a very large return. And some of those returns can range from 5x to 4,000x. And one of those is a great example was when Jason Calacanis invested in Uber. He was able to invest in Uber with $25,000 at like a 5 million valuation, right? So from the 5 million valuation into IPO, which has been closer to 60 to 80 billion dollars, his multiple was in the thousands, right? So what that allows him to do is not only keep equity in that, but to also use his money to invest in additional startups and to start his own syndicate, which he did. So that was kind of how like I kind of got started. And then it was really getting smart, right? Because just investing in, excuse me, in a company it's not as easy as it sounds, right? As far as like, if you want to make sure you're investing in the right companies. So, you have to consider a lot of things like the valuation, what is the company actually worth? And why are they valuing their company at X dollar? If they're saying they're valuing at $10 million, why are they valuing at $10 million? Is it because they have repeat founders? Do they have a lot of revenue versus debt? Do they have a lot of users? Do they have, very high margins, meaning basically whatever it is that they're creating versus how much they're selling it for, what's that percentage value gap there, right? So you're really kind of considering all of those things. And when you're first starting out, it's not that easy. I think in the first company I invested into, it was African American based. I invested like $600. It was my tax refund. I had like $600. I was like, you know what? I'm just going to put this in a Black company. And one of the investors in that company was what's his name? I can't remember his name right now, but he's well known. He's one of the early investors in Bitcoin. And right. So the thing about it is, right, like when we mention Uber, we mention it from a valuation standpoint, right? There's a lot of businesses, even early on, Amazon wasn't very profitable when it came out. And once they proved they could become profitable, they went back to burning cash, which is trying to beat up the competition. The reason why we mentioned Uber is because of the valuation as far as when they got started versus to when they IPO'd. And yes, Uber is burning a lot of money. That's why you kind of seen their prices kind of stick up. But Uber is just used as an example in understanding how valuations can grow over time. And if you're one of those investors that got in early, you can reap the benefits of them going public, whether they're burning a lot of cash or not, because they're still able to be on the public stock market. But so from there, I really tried to understand what type of securities were being offered. And what I mean by securities, when you're investing in early stage companies, there's multiple types of securities. So one would be a SAFE, which is simple agreement for future equity. That's one. Then you have common stock. Then you have preferred equity. Then you have convertible note. And then you have like a complete just debt round. And then you have a revenue share agreement, right? So these are the type of securities or offerings you can kind of see in the crowdfunding space. And all of them have different terms and different pros and different cons. But one you'll probably see the most is a SAFE, which is a simple agreement for future equity. And basically what that means is, let's say, for example, there's a startup and a startup is raising at a 5 million valuation cap under a SAFE agreement. Under that SAFE agreement, which means is they don't know what the value of their company is now, but they know it's somewhere between 0 to 5 million. So the pro to that is, let's say they have another round of financing. Let's say if you're investing at a seed round, the next round will be a seed plus or a series A round of financing. And they're saying, well, at this company, for whatever reason, we're going to be worth 10 million. for all the investors to invest at a 5 million valuation cap, the next round, they're just going to convert at a 5 million valuation cap. And everyone else who invested in the next round will be paying at a 10 million valuation cap, right? So the safes, they do sometimes convert, but you have to make sure you're paying attention to the Form C. So the Form C is kind of going to break down like a lot of the financials and who are their minority or majority shareholders for that company, right? And sometimes they'll outline exactly what are going to be the conversion terms, right? Conversion terms meaning they have to say, for example, in the next round, it's worth $10 million. And the first round, when you invested, it was worth 5 million. In order for the safe to convert, it being from a 5 million valuation, they have to raise X amount of money in the next round in order for your shares to qualify for conversion. And that conversion will be from a safe note from a safe note to common or preferred stock, whatever the next equity type of security offering that they're offering the next round, right?
Yeah, but even if they don't like reach that goal, that doesn't mean you're screwed out of your shares, right? That you're still an investor,
Well,
right?
yes, you are still an investor, right? But it's going to take a longer time depending on the terms for your equity to actually be like actual equity, if that makes sense,
Mhm.
right?
Yeah, we just want to make sure we're not suggesting that people will like lose their money because the people fail to raise, in the $10 million valuation. That's all I wanted to make sure of.
Yeah. So it will convert. It just has to convert on particular terms, right?
Mhm.
But you will get your money depending on whether it's acquired, because they have to account for all their investors, right? And or if the company goes public. But generally speaking, how it works is that in order to have that particular equity, it converts at a certain trigger event. And the trigger events will be outlined in those documents. But I haven't had a company so far not convert on the next financing round. So out of the 100 companies so far, I think maybe 30 of them might have had another additional financing round, right? So far. And this has been over the past three and a half years of angel investing. So generally the companies that I've invested into, most of them have converted over. Like, for example, I just got an email today. I invested in this company called Alto IRA. So Alto IRA is a website that allows people to use their retirement accounts to invest in alternative asset classes. So for example, if you have a retirement account, you want to use Alto IRA, you can take the money that you saved in your Alto IRA account and invest in startups, invest in crypto, invest in art, wine, and also real estate. Do that. So they just raised a $17 million Series A round at a 73 million valuation. So I got in that 30 million valuation cap with a 10% discount. So I pretty much doubled my investment in the past year. So that's one of my success stories for the day. But the biggest thing with angel investing is, you want to take your time. You really want to try to have a conversation with the founder sometimes if possible. I know at least I try to. And you want to do your due diligence. And part of that can be, researching the company, asking for financials, making sure you're tracking the Form C correctly, looking at their LinkedIn profiles and seeing if the company actually exists. There's other platforms you can do to gather data like Crunchbase. And there is another platform, I think it's called like Pitch Deck. And you can see a lot of the data that's supposed to be aggregated related to that particular company.
Yeah, and sometimes if people want King's Crowd is another option as well for finding opportunities and seeing how they're stacking up against others. Uh, so tell us a little bit about, well, I'm sorry, I wrote a couple of things down here. You mentioned, how I take my money the furthest is one of the things you were thinking of. And one of the things that I've been saying is we as people need to figure out how we can have our money working for us so that number one, it starts beating inflation. So keeping it in cash in the bank is like I hate to say the worst thing to do because you do need an emergency fund. But what the rich are doing is saying, but that money, too much money in the bank is not a good thing for us. So we do want to get into investments that are at least going to beat inflation. And then we really want to look at investments that are, going to give us great returns, but understanding that great returns come greater risk as well. So as you're growing, if you are not as affluent, then you may not want to put too much of your assets into these types of investments as well. So it really is about just balancing it out. So I wrote that down. And then I liked what you said about, really asking the question, well, why is this company valued at such and such a rate that you gave it? So everybody, when we do the bet on Black pitches, asking that question as well, maybe something we do a lot in our arsenal is asking that too. So Chris is asking here, you just said, make sure the company exists. What do you mean by that? I thought if they were on one of the platforms, then they exist.
Yeah, so that's just in general, right? Like sometimes what you'll see is a company will come out and they'll have a spinoff. So for example, a company can be founded, let's say in 2014, as one company, right? But then change the name, 4 or 5 or 3 years later, right? You kind of want to understand what happened between the first iteration of that company and why they branched off to see if maybe that particular first company failed, or how much money they raised versus what the new company is supposed to be worth, right? So, but if it is on that platform, I haven't seen a company that is not. What I'm saying is be very mindful of your due diligence process, right? So just because it's on a platform, they have their own due diligence process, but you want to make sure that the company is as legit as possible, just as an intelligent investor.
Yeah. Somebody else here in YouTube said, can you explain the stages in which a startup goes into the outside investor stage? What is the tipping point?
Tipping point. Yeah, that's a really good question, right? So usually how it kind of starts, right? So it's usually from pre-seed to seed to Series A, Series B, C, D, E, and sometimes F and sometimes G, right? And all those means are just different levels of financing or different rounds of financing that particular company received in order to kind of stay alive or stay afloat or to continue the growth as a company. And what was the last part of the question?
What's the tipping point with regards to them going for outside capital?
Going for outside capital. Well, yeah, I mean, it really depends on the company on each basis, right? It's not all the same, but generally going out for outside funding is trying to raise money to keep your business going. Like a lot of times you'll hear people ask, what's your run rate? What's your runway, right? And the runway basically saying like, based on your burn, how much time will your company stay afloat before it fails, right? And a lot of times companies are raising money to pay their employees for product development, for logistics, for partnerships, for marketing, and they're raising these funds to get either new hires or to go to the next stage of growth. And that's why they're kind of raising the funding.
So you mentioned that, 30 out of 100 companies that you have invested in have thus far like moved, to the next level, whatever the next milestone is. What is your process like? Because 30% is, not too bad at all. What is what are some of the things that you do within your process that you think we should consider?
Yeah. So what I do is I try to figure out, am I, in love with the company, right? Or can I really appreciate what they're doing and what they're trying to offer to the world?
Mhm.
And, like initially when I first started out, I was primarily focused on software as a service type of companies, only because I feel like those had the highest margins. But now what I've
Oh, don't read the chat. Just keep going. I'll get to the
sorry.
question.
Yeah. So yeah, and initially like I was really focused on software as a service companies, but what I found out was I would rather be not narrowed in one particular sector or one particular field, because there's opportunities across the entire sector, right? Like you can, plant-based foods, let's say EV companies, hardware and software, logistic-based, software as a service-based, AI-based, machine learning-based. And I think, yeah, what was the question again? Sorry. What kind of,
So the question is 30 out of 100 is a very good track rate thus far. What are
right?
some of the things that you're doing,
Yeah,
for that success hit
yeah,
thus
sure.
far?
So in addition to that, I kind of researched, like, out of the companies that already invested, the ones that were successful in raising an additional round, what are the key metrics that they kind of had in order to get to the next stage, right? And I try to emulate that same process over and over and over again. And primarily it's going to start off with the founding team. Like, do I think the team has what it takes to get to the next level? And it's primarily going to be based off of, one, do they have enough cash? Two, who else has backed them as far as like venture capital? Because a lot of times other VCs won't invest unless they haven't seen another VC invest in a company, right? The second thing is based off their business model, like the type of company that they're running, or the type of business that they're operating in, or the type of space they're operating in. Do I think they can make enough revenue to move on to the next stage of growth, right?
Mhm,
And what's their backstory, right? Like,
mhm.
did they used to work at Google? Did they used to work at Facebook? Did they specialize in some type of education that says like these people are the right persons for the job, right? And are they truly inspired and believe in what it is that they're truly doing? And do the numbers make sense, right? Um, and another thing is like not being too caught up on the evaluation sometimes. Like a lot of times evaluation, it's not solely based on where they are right now, but where they could be if they get the right financing, right? So it's you finding that sweet spot, like the different stage in growth. What I mean by the different stage in growth is like, is it a seed round? And at the seed round, why are they worth 5 million? And at a series B, which usually means they're probably going to be able to get acquired or go public within the next 5 to 6 years, depending on how most companies usually go public within the next 10 to 11 years. Because most companies that are private usually go public within 10 to 11 years from the time they kind of started or they first received their financing. So you got to identify, why are you investing at this particular stage? How long do you think this particular stage of investing will have to be held until you get an acquisition or you get an IPO? And understand that this is a waiting game, and you're going to be illiquid for a certain amount of time. So, and I say that because not all my investments are pre-seed, not all of my investments are seed stage. Some of those are later in the game. And when I mean by later in the game, they're either, 100 million valuation, or sometimes even 200 million valuation, because I just like the company that much. And usually companies that have valuations that are higher than 200 or close to a billion, they're really close to IPO. And sometimes that could be a quick 3x. And you might have the ability to sell your shares within 6 months to a year of that company going public. So being able to at least try to have a conversation with that founder, and asking the hard questions, right? And being able to figure out whether or not this particular founder or this particular company is being transparent with you, right? And understand the competition, not because competition is everything, because Facebook, there was other companies out there when Facebook kind of got started, right? But Facebook had a really intricate way in which they got started. Some of it kind of shady, but they had a very strong ecosystem in the way they got started. But doing that, and understanding, like, do I think this particular company right now, based on the other companies that are raising money, is going to have a successful crowdfunding round, right? Like, if there are five companies that I find interesting, and I want to invest in a company that I somewhat like, or the ones that I'm really, really, really passionate about. And those are the ones that I want to kind of get involved in, because they're the ones that I'm going to do the extra work and due diligence to either help market that business, talk about that company, see how I can be a value add investor, as opposed to just writing $1,000 check or $500 or whatever it is. what company do I see myself looking forward to being around for other people to use or other people to enjoy? It's kind of that process, and being smart and understanding like what type of securities are being offered for this particular round and what makes the best decision based on your financial situation, right? Like, some people, you might not want to go really heavy just starting out. You might just want to get your feet wet and, maybe put $100 in there and see what it does and give it some time, but understand that with more risk comes reward sometimes, not all the time. And you can try to do the math and the multiple and see exactly, based on this valuation, an X amount of time, what I could be looking at in the years to come. But none of those things are necessarily guaranteed. So it's really about becoming as serious and as strict as possible in the process to give yourself the best opportunity to be successful in investing in startups.
Sorry, everybody. My dog. Yeah, so somebody did ask in here about perfect. Thank you. I was going to ask you about your light. If you were investing in Black-owned companies as well, but it seems to me like you're just looking for the best companies to fit your portfolio.
Yeah, and believe it or not, yes, I've invested in Black companies. I've more so focused trying to investing in companies that are CEOs of women, because women have been able to take less amount of money and make more of it than men have. So I've been trying to find.
You have some fighting words there.
I mean, it's statistics. I mean, it's stats or stats, right? I mean, and if that's what it is, that's what it is. But
that's
yes,
actually
I had
true. Kevin O'Leary from Shark Tank said the same thing. He said that of all his portfolio, the female founders weren't like the first, but they were always profitable for him. So I thought that was very interesting. Men tend to swing for the fences for the home run, and oftentimes, they strike out. But a woman and women-led companies tend to do more calculated risk, so they don't grow the fastest, but they tend to have longevity. So yeah. I would love for us to go over the Super Founders book. So for anybody who's late, this is a book called Super Founders by Ali Tamaseb. And it is what data reveals about billion-dollar startups. So I started reading this about halfway through it, but there was an article that he wrote on Medium where he shows his data points. Now, there are 50 of these that he has. We're not going to go through all 50, but I've highlighted several, and I thought Raymond would be pretty interesting. Some of the things he's actually said tonight thus far, and then some of the things he hasn't. Another thing I want to say before we open up this article is this is not an end all be all. This is based on the billion-dollar startups that have been done thus far. But I will tell you, a lot of Black founders have said to me that they've gone into these VC meetings, and these VCs have said, we've never seen a Black person do a billion-dollar company before, therefore we're not investing in you. Basically has been said to them. So as we're looking at these data points, I don't want you to think, as we're going through the Bet on Black pitches that it can't be done, that we can't do it. I think that we have not been given a chance and an opportunity, but that tide is changing as well. And that's some of the things that I would love to see more 10K members help put in place so that we can build more billion-dollar companies. So this is the land of the super founder. And a super founder is somebody who builds a billion-dollar company. Okay, so this guy did a data-driven approach to really understanding what these billion-dollar founders were doing when they started the company. And again, I thought this was a very interesting book that he has here with a whole bunch of data. So he has here 30,000 data points with regards to this study. And he also interviewed a whole bunch of people. The interviews are interesting within the book as well. Again, if you're a geek and a nerd with regards to this, you'll like it. And this Super Founders here, this is what the book looks like. Super Founders, what data reveals about billion-dollar startups. If you really want to study being an investor, these are the types of things you want to study. He spent about 15 months working on this. He embarked on a journey to answer a personal question. What did billion-dollar startups look like when they were started? He asked questions like, how many competitors did they have when they started? What were their defensibility or moats? Did the founders have work experience in the same sector or industry? How many years of overall work experience did they have? Did the founders work in a startup before as an employee? Were they successful founders already? Did they go through an accelerator program? And how long did it take for them to, from when they started to when they got their first check? So, and he asked a lot more than this, but I thought, again, this was a very interesting point of view that he took with regards to this book. So, of course, the disclaimer in here is it can't be 100% accurate because of some of the lack of publicly available data, yet he did his best. So I just wanted to add this in here as well. But here are some interesting things that he found. Number one is 2 or 3 is the most common number of founders. So again, for companies that became billion-dollar startups, they usually had co-founders, which I thought was pretty interesting. The majority had either 2 co-founders or 3 co-founders, and just one founder. Still was about 19% of companies that became billion-dollar companies were started by one person. And Raymond, you could stop me at any time that you find something interesting that you want to chime in with.
Yeah, so
Go ahead.
yeah, so can we scroll up to the question section?
Oh, yeah, sure. I'm sorry. Here you go.
Yeah, so one of the ones that kind of stuck out to me was that they go through an accelerator program.
Mm-hmm.
And so I'm not sure if everyone's familiar with the YC or Y Combinator. It's an accelerator program.
Mm-hmm.
Usually a few times a year they have what they call batches. In those batches, they pick a selection of a few companies to which they're going to automatically invest a few, I think it's between $75,000 to $100,000. And they're going to get 7% equity in that company. Now, statistics have shown that companies that go through the YC Accelerator Program, they have a 3x more potential or likelihood of being successful as opposed to companies who have not went through that accelerator. So I just thought I just wanted to put that out.
Yeah, absolutely. But you'll find out later on in this this list of statistics here is that 90% of the companies that made $1 billion plus in valuation were not part of an accelerator. So I thought that that was very interesting. But they did say of all the accelerators that people did participate in, Y Combinator was the number one accelerator because they prepare you to be an entrepreneur. So I thought that that was pretty interesting. Okay, so we talked here about the number of co-founders. The second stat here is that more than half of the founding CEOs are over 35 years old. I like this because we keep hearing of the Zuckerbergs and people like that who dropped out of college and, started a billion-dollar company from their dorm and things like that. Yet some of us are 35, 40, 45 years old, and we may be thinking we can't do it, because we don't hear our stories out there. I'm here to say that you can, and the data is here to say that you can as well. It does look like the sweet spot is in between like 25 and 35. I would say 45, but I thought that this was interesting too. I love this. Next is, let's see, I'm just going to keep going until I see another highlighted section. Directly relevant industry experience does not matter. It matters even less for CXOs. So, contrary to popular belief, most founders don't have any directly relevant work experience in the industry that they are disrupting. There's also a clear distinction between the CEO and CXO, where the industry experience is even less relevant. I thought that this was very interesting here. I'm going to show you the numbers here. So, founding CEO directly relevant experience, there were close to what, 55% that had no experience in the industry. And then CXO is like your CFO and your chief revenue officer, CTO, et cetera. Over 70% had no direct relevant experience, even though they built a billion-dollar company. Raymond, what do you think about that? Because that actually is contradictory to what we've always learned within being an angel investor. I thought that that was interesting.
Yeah, I mean, numbers don't lie, right? I
Mhm.
mean, I think, and obviously isn't always the case, but if it's
Mhm.
think about the majority of the companies that were reviewed or interviewed or data analyzed, and then that number is what it is, right? But
Yeah.
I know for myself, when I've seen startups hire, most of them hire for individuals who's going to have some information or some data in the subject in which the company is being based upon, right? Like if it's a really in-depth machine learning type of company, they're going to get a lot of people to understand data analytics and data science and development, right? And the core team is going to have a really good understanding of those type of fundamentals, right?
Mhm.
But I mean, nothing is nothing is everything. But I mean, the numbers say that's what it is, and I mean that's what it is.
Yeah. I was listening to a podcast by a guy named Ryan Daniel Moran, and he said that one of the things that a billionaire friend of his told him was that an owner's job of a business is to um, staff the company with the talent that's needed in order to make it grow and make sure that that company has the funding and the money that it needs to act on the business plan and the strategy. So I think what's happening here, Raymond, is they're finding CEOs because they're going to say it further down that these companies are always raising funds. I think they're finding CEOs that know how to do that, that know how to make sure that the company is always liquid and it has a strategy. And then they hire the best people and they say, okay, you go. I'm going to just make sure that there's money in the bank at all times. So, um, but this is something that I thought was interesting. This stat that we set above, no experience, does not work in healthcare and biotech. 80% of the founding CEOs have direct, relevant experience when it comes to healthcare and biotech, which makes sense. And in fact, within the book, they have some really fascinating biotech um, interviews with some of these billion-dollar plus CEOs. So, another thing that they said is that almost 60% of successful entrepreneurs that are billion-dollar founders are repeat entrepreneurs. So they're serial entrepreneurs. And in fact, what the book said was that um, the most successful entrepreneurs were ones that had like any kind of successful exit before, whether it was $1 million, $5 million, $10 million, and then they got into another business. And because they had already had the failures, which all entrepreneurs fail at some point, and then they had a success, even though it was a small success, they knew how to turn their next thing into the billion-dollar company. So I thought that that was very interesting. So let's see here. Um,
So I have another
Go ahead.
obligation coming up shortly.
Okay.
I'm not sure if you had any additional questions
Well,
for
let's see
me.
if people have additional questions for you, Raymond. Chris is saying here, I see Kevin O'Leary promoting heavily on platforms that are connected to him. Do you think it is wise to support him or to focus on the 10K project or follow both? Well, I guess it depends on what you mean by support. Um, I support the lessons that he was teaching us circa 2016. I think that's when I heard him say that specific stat about the women. I think now, things are a little bit different. Well, things have always been different with all the sharks because they're all salespeople no matter what. I'm focused on 10K, but I also invest in other companies as well. So, you know, um, Raymond, do you have any final words? Everybody, I want to stay with you if you all are able to stay because I want to go through some more of these data points. But Raymond, do you have any final words for the family?
Yeah, what I would say is, just appreciate the process. And you don't always have to try to swing for a home run. Try to look for those projects that look very promising, or the ones that you can be passionate about, and really putting your dollars towards. And I believe in investing in Black companies, but you want to invest in companies that you truly, truly believe in, right? And understand that this is going to be a long-term investment. And most of these things takes years to come, 5 years, 6 years, unless they get acquired, and those things, they do happen. So I mean, I have a few companies that were acquired and it was a nice quick little 2x or 3x, which was nice. But I'm really not minding waiting, 5 to 6 years for something that could be 100x or 1,000x potentially. So enjoy the process, learn as much as you can, and do your own research, right? Like there's a lot of people out here who think they're, gurus or experts in the field, but what it ultimately comes down to is, are you disciplined enough to do what it takes to learn as much about that company before it closes its round, right? And trying to be as comfortable as possible because you work very hard for your money, and you don't want anyone just not using your money wisely. So learn as much as you can, appreciate the process, and there's tons of resources. I'm always on Twitter, and you can always message me on LinkedIn if you have a LinkedIn, and just be willing
What's your
to
Twitter?
learn. Twitter,
What's your
yeah.
Twitter URL?
So I can type it in the chat box, right?
Okay. Yeah, sure.
Yeah. So let me make sure, give you all the correct Twitter.
And everybody, please put exclamation points in for Raymond. Tell him that we appreciate him. Throw an exclamation point in the chat so he can see those as well. I see you on YouTube, so definitely we're going to put Raymond's Twitter handle in YouTube and in Facebook. Um,
Thank you. I appreciate everyone.
Yeah, we see. All right, so it is at Chandler_invest. At
Yeah.
Chandler_invest is Raymond's Twitter.
Yes. So when you see it, it's a robot. It's an NFT robot. So it's not my actual face because I really got heavily involved in NFTs, non-fungible tokens, which is like the next big wave in the crypto space. So, but it is me. You'll see a list of a couple of the companies I've invested into. You can click on those and check them out. But yeah, thank you all for, thank you for inviting me to the 10K project. I'm glad I was able to come and kind of share some of my knowledge, and I
Yeah.
have it as a, blessed and safe evening, and learn as much as you can. And I hope everyone has a nice exit one of these days.
Thank you so much, Raymond. And everybody, I'm going to stay on for just another 10 minutes because I just wanted to go over the rest of this data. I'm super geeked out and we're not going to have another chance to do it this year. So thank you, Raymond.
All right, take care.
All righty then. So everybody, I'm going to go back to sharing my screen here. We're going to do this super, super fast. Okay, so this is something that is interesting, but, and I'm going to tell you all a little bit of background about it as well. They're talking here, again, we're coming back to this book around super founders, what data reveals about billion-dollar startups. And this is more about where the people were when they got their first investments in their businesses that, ultimately grew to billion-dollar plus valuation. So the founders had worked previously in tier one companies. So they consider tier one companies like a Google or a Facebook or something like that. And one of the reasons within the book that they felt like these companies sorry, people who worked in these companies were then building billion-dollar companies is because these companies are very entrepreneurial themselves. They allow people to go in and play with things. They allow people to go in and experiment with making the products better. And they also felt like co-founders were able to find each other very easily. My question is, how can we as a people start creating companies like Google and Facebook that has like that entrepreneurial spirit within it? Uh, a lot of you, because I haven't had a W-2 in many, many years, but a lot of you are probably working in places where they just have you stamping something. Um, my suggestion is as we start creating our own companies, we want to think about how we can create environments where young people are able to come and find the inner entrepreneur within themselves. And then what happens is Google, and well, Google more so than anybody else, when these employees start like finding their own companies and starting their own companies, Google will invest in those companies. And that's part of the reason why they're making it so big as well, making so much money. So that's just a thought. Google, Oracle, and IBM are the biggest billion-dollar founder producers out there. Also, McKinsey and Microsoft has generated a bunch of CEOs as well. So, okay, the next thing, our schools here. So they have here Stanford, Harvard, and MIT produce the most CTOs and CEOs. So we know within our community, one of the big things I believe that is needed is just more investment in our HBCUs and in the entrepreneurial programs within the HBCUs. Within the book Super Founders, what they talk about is, again, a lot of these students get together to do business plan projects, they're in MBA school together and things like that. And because of that, they're being taught in an entrepreneurial environment. So we want to support our HBCUs and our Black students at PWIs as well, and see what they can do with regards to being encouraged to be entrepreneurs. The next thing, most common themes, anything from cloud, data, mobile, and marketplace. Now, he says this here, I have it highlighted. The themes in the next 14 years will not necessarily be those of the past 14 years. So, for example, Raymond talked a lot about being in SaaS. SaaS stands for software as a service. That's not going to be the hot thing in the next decade. DeFi, which is decentralized finance, is going to be really big. AI is happening right now and will continue to be big. Certain biotech things, you know, based on last year, especially, are going to be hot. So you want to really start, as you become a more serious angel investor, looking at the trends and looking at where the world is going to be in the next 10 to 15 years and what companies are handling some of those issues. So let's see here. It's only a few more that I have here. Um, some companies that do well are in B2B. B2B stands for business to business. So they're making products for other businesses. And then some of them are B2C, meaning that they are business to consumer. So, you know, some of the companies that we invest in within the 10K project should be geared towards B2B, business to business, and others should be B2C. So that's just something you want to have within your thought process. Contrary to the belief that these companies are low capital intensity, a disproportional percentage of billion-dollar startups require a high investment to build and scale their solutions and products. What this means is billion-dollar companies require a lot of capital. And in fact, a little bit further down, they say that it requires about 250 to $400 million. That means for us as people within the 10K project, we're going to have to understand that the billion-dollar companies that are forthcoming, because I believe that they are going to have a 7 to 10 year period of raising a lot of money from venture capitalists and other private equity companies and later stage investments. So that's just a part of the process that they're going to have to go through. I love this one here. Over 50% of these super companies were competing with multiple incumbents at the time of founding. That means that there was a lot of competition that these companies were going up against. Later down, further down in the article, it says that they, however, created a product that did have something special with it. But one of the things that I want to make sure of is that we're not afraid of competition. That's according to the numbers here. So, they're saying that 50% of these super large companies had major competition and multiple incumbents, meaning that companies that were around for many years in that target market. They had it at the time of founding. So they went in to disrupt the market. They went into, to take over a market, et cetera. So I thought that that was pretty interesting. Let's see here. But the product did matter. I already mentioned that. I'm going to go through these a little bit more quickly because I got y'all for 3 more minutes. Another thing, the market was already large at the time of founding. These big companies went after markets that were already very large with demonstrated high demand. They did not create demand in the majority of cases, and they did not wait for the market to mature. So they got in on the upward trend, but they didn't try to create a market. And they didn't wait until everybody had what they needed from the market in order to grow. So, or in order to get started. So I thought that that was very interesting. Over 60% went in with large markets. And then, you don't have to be first or you don't have to worry about necessarily being first. It's okay to be last into the market. It didn't matter if you were first to market or not. I thought that that was very interesting as well. And I talked here before about over 90% are VC funded. So when these companies come to us to raise capital, oftentimes we'll be the first or second round of funding that they're looking for, but eventually they will go to raise money on the market. Sorry, through venture capitalists. I'm sorry. So I'm going to put the article. I just put in the chat for everybody because I kept y'all for long enough. The article and the information, this is Super Founders. This is the book, Ali Tomasev is on. So I put the article in. The article's in Medium. So you can just get the data, or you can actually look in and read the book and also get more of a feeling of what was happening in the brain of the founder when they got started. So the stories are very, very interesting. If you're an entrepreneur that wants to grow $1 billion company, this is a must for you to read this in order to really understand what you're getting into. And with that, I don't know if I don't see any other questions here. I want to thank everyone for being here today. Super excited to have had Raymond here. And also make sure that if you're not a member of the 10K Project, you come to the10kproject.com. You can learn more about us and you can ultimately become a member. Okay. Thank you, Jackie. I'm always open for learning. Love it, love it, love it. So, all righty then, everybody. Have a good evening and we'll see you tomorrow for the Bet on Black pitch.